Australia's unemployment rate just printed 4.5%, the highest reading in 4.5 years, and the market's immediate response was to buy equities. That inversion is the story. The expectation going into Thursday was that the Reserve Bank of Australia still carried live hiking risk. As recently as last week, money markets were pricing a non-trivial probability of a June tightening. The April jobs data erased that pricing in a single session. The mechanism runs through rate-sensitive sectors. Youth unemployment drove the headline miss, which matters because it signals discretionary labor shedding rather than structural labor hoarding, the kind of softness the RBA cannot dismiss as noise. Retail investors who had been underweighting banks and rate-sensitive REITs on the assumption that higher for longer would compress net interest margins reversed that positioning. From price and volume action alone, the ASX 200 added 125 points, with BHP and Rio Tinto each up 3%, and the major banks strengthening, interpreted as institutional reweighting into cyclicals and yield sensitives as the hiking premium unwound. The countersignal is the AUD. The Australian dollar dropped toward 0.7100 against the USD and hit a one-week low against the NZD. That currency move prices in not just a June hold but a potential easing cycle, a more aggressive interpretation than the equity rally implies. If the RBA confirms a hold in June but signals unchanged rates through year-end, the equity repricing holds. If the currency market is right about cuts, the growth signal embedded in that unemployment print is severe enough to challenge the earnings base for the same banks and miners that rallied today, and the rate relief trade reverses into a growth concern trade. The verification benchmark is the RBA's June statement language. A shift from not ruling out further tightening to neutral guidance would confirm the equity repricing. But the unemployment print that just killed the hike thesis also leaves the question of whether it killed it for the right reasons, or whether the weakness is deeper than a hold can address.
The same macro repricing that lifted ASX 200 cyclicals ran directly into a governance rupture at Northern Star Resources, and the two events are causally connected in a way the headline juxtaposition obscures. Stuart Tonkin's departure after a decade at the helm follows a sequence of production downgrades that progressively eroded the company's premium valuation against global gold peers. The CEO exit is not the cause of the re-rating, it is the admission that the downgrade cycle was structural, not transitional. Northern Star had been held by domestic institutional funds as a gold sector compounder, a thesis built on the super pit scale and Tonkin's operational credibility. That thesis required the company to sustain throughput guidance, and each successive downgrade fractured the credibility premium rather than just the earnings estimate. The capital flow interpretation from price action is that domestic institutional holders who had maintained overweight positions on the thesis that management could arrest the downgrade cycle have now lost the anchor for that position. The succession announcement removes the continuity argument without replacing the operational thesis. The complication is timing. Gold prices remain elevated on Middle East tension and USD softness, which means Northern Star's underlying commodity exposure is not the problem. Its operational execution record is. A new CEO inheriting a high gold price environment but a structurally challenged mine plan faces a different set of decisions than a turnaround in a commodity downturn. The question the market cannot yet price is whether the successor will simplify the portfolio, the mining press flagged that possibility explicitly, or defend the existing asset base. That structural decision, not the gold price, determines whether the institutional overweight is rebuilt or unwound further. The 4.5% unemployment print that gave the broader ASX a lift did nothing for this particular repricing, because it is not a macro rate story. It is a company-specific credibility story operating entirely inside the resources sector's governance frame.
The rate relief rally and the Northern Star governance question both feed into a third variable that neither fully resolves: the Labour government's capital gains tax overhaul and its transmission into Australian property markets. Morgan Stanley's warning of the largest house price correction in 40 years, cited across multiple outlets Thursday, is not a macroeconomic forecast independent of the week's other events. It is a direct response to the budget's CGT changes, which alter the after-tax return tabulation for investment property holders in a way that Morgan Stanley believes is large enough to trigger forced disinvestment at scale. The mechanism is portfolio frame disruption rather than incremental repricing. Negative gearing and the CGT discount have historically anchored the investment property allocation for Australian high-income earners and family trusts. The budget changes reduce that discount in a way that narrows the gap between holding and selling, and for leveraged property investors, the RBA rate hold confirmed Thursday actually complicates the decision further. Lower rates were meant to be the pressure relief valve for mortgage stress. If the RBA holds rather than cuts, property investors facing a worse tax treatment cannot rely on refinancing costs falling to restore after-tax cash flow. The housing market bears the friction of both the tax change and the rate hold simultaneously. The equity transmission is through listed property and REITs. Retail and institutional money had begun rotating into ASX-listed property trusts earlier in the year on the assumption that a rate-cutting cycle was imminent. That thesis has now been replaced by a hold-and-watch posture, and the CGT changes add a sentiment headwind to what was already a rate path-dependent trade. The verification benchmark is the next CoreLogic monthly clearance rate, specifically in Melbourne and Sydney investor-heavy precincts. If clearance rates hold above 60% in the fortnight following the budget announcement, the Morgan Stanley 10% correction scenario is priced too aggressively. If they fall below 55%, the scale of the policy-driven disinvestment is large enough to validate the structural correction thesis, and the rate relief that lifted the broader ASX on Thursday becomes a footnote rather than a floor. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.